What's up, Sats fans? Welcome to Swan Signal Live. We got another great episode for you today. I am your host, Sam Callahan, lead analyst at Swan. Today we have two regulars. We got James Lavish and Lawrence Lepard. But before that, I want to tell you about Pacific Bitcoin, which is the conference that Swan puts on October 5th and 6th in beautiful Santa Monica. If you didn't go last year, you missed out. It was one of the best conferences of the year. Just a great atmosphere, fun, great speakers. It's a chance to meet your favorite Bitcoiners and some of the smartest people in the investing world in person. And so check out Pacific Bitcoin at pacificbitcoin.com. You can use the promo code SIGNAL to get 21% off your purchase if you hit that QR code right there. So before we get into it, I also want to just bring up one thing about Swan, which is Swan Private. If you go to swan.com/private, we service high net worth individuals for all of their needs. So check out swan.com/private today. So let's get into the show. We got Lawrence and James. We're going to talk about all the things. Welcome, gentlemen.
Welcome, Sam. Nice to be here.
Sam. Thanks for having us, man.
Yeah. So I was just talking to Larry. I just got back from Italy for the last 2 weeks. We were kind of talking about Rome. We were talking about Florence. And the one thing that I was just flabbergasted by was how they built these buildings hundreds and hundreds of years ago, just intricate, beautiful, and they're still standing today. And I get back to America and look at these like cardboard boxes and I'm like, oh, what happened here? And obviously I think about the money. And so when you look at the state of the money today, of the debt system, of the currencies, I mean, what are your guys' thoughts right now when you think about the fiscal situation? Because let's just start there.
Go ahead, James.
I'm laughing, but it's not funny. The system we're built on is we're so over levered right now, and all the cracks are starting to show. And so, we've seen the markets melt up. We've seen just money pour into risk assets, and I don't trust it, Sam. I feel like I've been in this game long enough to know that you've got to watch out for that black swan that you don't see, but you get this spidey sense. And I'm sure Larry's felt this a number of times before in his career, where you're just like, there's just too many signs out there that something could break. And the leverage in the system is not only the trigger, but it's also just that weight that'll bring everything down that you just have to be aware of.
This whole system is so broken. It's such a sick joke. I mean, fiat is basically failing as we speak. And it reminds me, I'm a pilot, it reminds me very much of, when you get into, if you're flying IFR and you lose control of the plane, what you tend to do is you want to pull back on the stick. And that tightens up the spiral and makes it worse, and you only crash faster. And what the Fed has done, what Powell has done, is he pulled back on the stick by putting interest rates up as high as they've gone. And you're watching the U.S. interest expense just go parabolic, right? And I mean, this is it, folks. I mean, we're in the end game here. It's obviously going to take a little time to play out. It doesn't happen in days, but it's happening. I mean, there's no going back at this stage.
Yeah. So for people to understand, I mean, we've borrowed another $1 trillion since the beginning of June. Okay. So our debt is up over $36.5 trillion, or I'm sorry, $32.5 trillion. The Treasury just expects, they just put out that they expect to borrow, wait for it, $1.86 trillion in the second half of 2023. That's after borrowing $1.3 trillion in the first half. So,
that was 300 or 400 higher than what they projected as recently as 3 or 4 months ago. So
that's right.
It's getting worse and worse, right?
Yeah, and like you said just a second ago, Larry, we're on track to pay about $1 trillion on interest on our debt this year.
Right.
$1 trillion.
Yeah, which is basically larger than the U.S. defense budget. It's in the 800 range. So
that's right.
Yeah, I mean, look at that parabolic rate, right? I mean how does this end well?
I mean, I think even like somebody who's not a sophisticated investor who's not educated in the markets can look at that interest expense and just say $1 trillion, like that doesn't make sense. And it seems like the rating agencies did say that. Fitch came out and downgraded the government debt and had a lot of people kind of wondering, is this going to be payable in the future? Like, is this actually a sustainable path? And this is the projection that I pulled from one of James' recent newsletters, but it just looks at the debt held by the public going out to like 2090 over it was 600% debt GDP. I mean, how could they not expect it to get downgraded?
The best part about this chart right here, and hat tip to Lynn Alden, who was the first one to find it. But this was actually this was published by the Treasury, and it was in a report. It was the State of the Treasury report, and it's basically a love letter, hate letter to Congress, saying, this is the path we're on, and that was not my subtitle. That was their subtitle to the report, an unsustainable fiscal path. And they know it. They absolutely know it. And they're trying to get Congress to look. The Treasury, they're the bank account. They're the banker. They're like, they're like the money manager who's trying to get the rock star to stop spending so much money. He's going to be broke. That's who they are. And they just have to keep issuing debt in order to pay for everything that Congress has agreed to purchase. And so, they understand that this is just not mathematically sustainable. And so that was their report. And it's just incredible how we're, and then what you just said, Sam, about Fitch taking notice. Well, Fitch got on board with the S&P. Basically, the S&P downgraded the U.S. debt back in 2011. Is that correct, Larry? And so what happened there is they saw what happened in the Great Financial Crisis, right? So the S&P watched what happened in the Great Financial Crisis. They watched all these banks. They watched the Fed step in and expand the money supply, and they knew that this issue of the debt ceiling is not going away. And so every single time that we bump up against the debt issue, the debt ceiling, it becomes a political football between the two parties. They both are raising the debt ceiling. They don't care, but they're trying to trick the other one into making a mistake that would cost them votes with their own constituency. There it is, So every single time we bump up against a ceiling, we raise it. It's a farce that we even have a ceiling, but it's supposed to be there to keep us fiscally responsible. Obviously, we're not, and so we keep raising it. So what just happened with Fitch? Well, Fitch said we did it again. This spring, we bumped up against that debt ceiling again. It got so bad that we got down to like $30 billion, which they spend before we have our first cup of coffee in the morning. And they were in almost panic mode. And they said, okay, we've got to raise the debt ceiling or else we default. And they're not going to hard default. No country who issues debt in their own currency would hard default. They'll just print more money and monetize it, right? They'll buy their own debt and make it like it's monopoly money. And so what Fitch is saying is that there's a high probability that we bump up against this debt ceiling again, and we do default. We have a technical default. And when everybody says, and I hear everybody on the internet and all the experts on Twitter say, oh, but it's no big deal. It's not really a real default. It's just a technical default. Everybody gets paid. But you're not thinking through what happens on the other side of that trade. If you're a major institutional investor, okay, and you've got $100 million worth of bonds that are coming due, or $1 billion of bonds that are coming due, and they're not paid, well, you may have borrowed against that. You may be using it as some sort of collateral to some other trade. You may be expecting that cash to settle another investment. You may be making private investments and have sent money and expect this money to come to you in order to pay that. And when it just doesn't show up for a couple of weeks, it's a massive problem. And if you go back to 1979 when this happened, and Larry, you may remember this, it was before my investing time, but it was a disaster. The Treasury wasn't set up to send money instantly and fix this problem, right? And so they had to physically put checks in the mail to send out to investors, because Congress took too long. They settled their difference at the last minute. They had a technical default. They made everybody whole, but it was a mess for weeks there. And then spreads blew out because of it. It's not a non-event. And I'm sick of hearing everybody saying it's a non-event. It's not a non-event. This is a major deal when we trip that debt ceiling. And we default, even if it's a technical default, it's a problem. It's a problem for investors. It's a problem for the U.S. debt. And it puts a big spotlight on the fact that we are incredibly fiscally irresponsible. I'm going to get off my soapbox now.
Well, I think that's right. I think the important thing is that the world is watching all of this very carefully. And as an example, you've got a BRICS currency, meeting coming up on August 22nd in South Africa. And, who knows what they're going to say, but they might say that they're looking for alternatives to the dollar, and that, there's been talk that maybe gold will be one of them, and so on and so forth. So, the entire world watches the way that we behave, and we're behaving incredibly irresponsibly. And yet we have to, because you can't taper a Ponzi, as Max Kaiser points out. And so, although Powell is trying to do the impossible, which is calm down the monetary excess, which, they started when they printed 42% of the money supply in a 2-year time frame, he's not going to succeed at it. He has to fail, or if he wants to make the dollar money good, he has to completely crater the leveraged economy that we live in today, and we'll have something that'll look like the 1930s. And of course, we know that won't happen. So really, the only issue is, we're now bouncing up against the deflationary guardrail. M2 is shrinking for the first time in a long, long time. But things are starting to break, and we saw Silicon Valley Bank break. And, if they wanted to have real capitalism, what they would have done was, they would have followed the black letter law that was laid down in Dodd-Frank that says those wealthy depositors and venture capitalists at Silicon Valley Bank, they should take a haircut on their deposits, because the managers of that bank fucked up. They bought low yield, long duration securities that were deeply underwater. And so what needed to happen, if we wanted real capitalism, is they needed to let Silicon Valley Bank fail and let those depositors get a haircut, because that's what the law said they should have done. In fact, what they did do, of course, because they knew there would be contagion, they knew the entire system would come unglued, is they came in with a BTFP and they bailed them out, and they effectively, whether you call it QE or yield curve control or printing money, it doesn't really matter. The fact of the matter is they did what they've been doing since 1987, which is to say they bailed out the irresponsible. And as a result of that, and then they put it all back in the can, and now everything's supposed to be good, and we're supposed to go forward. Stock market's going to rally. It's all great. But here's the issue. It's going to happen again. And when it does, we've seen it over and over. I can cite 20 instances of where, when the rubber meets the road, the Fed fulfills its initial good guideline. When it was set up in 1913, it was meant to be a lender of last resort. And it didn't take them but 3 years, and that's what they became. In 1916, they funded World War I by printing money, and they weren't supposed to. And guess what? They've been doing it ever since then. Over 100 years of, when the rubber meets the road, they will print the money, which is why James and myself, and I know you too, Sam, are just so absolutely comfortable that monetary debasement is inevitable. It's just inevitable. The only issue is, which way. I mean, as I like to say, they're driving a clown car on an icy road, and they bounce off of two different guardrails, massive inflation and massive deflation.
And they're steering the car, looking in the rearview mirror.
Yeah, that too. Yep. Yeah, right. But other than that, it's all good. Other than that, they're geniuses. They've got 300, 400 PhDs who work at the Federal Reserve. The Federal Reserve governors make $400,000 a year, and they get to front run the rest of us, like my classmate from Harvard Business School did. The guy who was running the Dallas Fed, I'm forgetting his name now, but
Robert Kaplan.
Kaplan, exactly. And trade the S&P 500. And of course, he lost his job over that. But, that's just, that's par for the course. And, the rest of us plebes, we have to deal with this money that they're, effing around with 24/7 for all of our lives. And they've hurt innumerable people and innumerable families, people losing their homes, people getting over leverage, just all kinds of things. I mean, this is a criminal system that is incredibly unfair to people throughout the entire world. And it's why it's absolutely essential, in my view, that we've got to fix the money to fix the world.
Yeah. So you brought up the bank term funding program, of how they kind of came in with these emergency programs right when the system started to get shaky once again. But you said this is just like 1987, and I think you're referring to the Fed put,
Yeah,
famously put
so
on by Greenspan. And I
I
wanted to
remember it
ask you,
well.
yeah. I always say like it all started with Greenspan, and people my age like look at me like I'm crazy, like they don't even know who
Oh
Greenspan
no, yeah,
is.
he was the original Mr. Big Stuff. I mean, I call him Patient Zero. I call Bernanke the super spreader because because he came along with a helicopter speech. But yeah, I remember it very clearly. I started my business career in 1982 or 3, and it was 87, and I was in California, and I was a venture capitalist, and I was, I had a personal account, and I was trading stocks in it, and I was massively short because you could see just how overvalued everything was at the time, and the crash of, the dollar was getting hammered, and you could see that, and the stock market dropped 20 some odd percent in the space of a couple of days. And I made a lot of money on that personally. I mean, the scale was quite small because I didn't have a lot of money, but I made percentage-wise a good return. And of course, a couple of days later, they came up. It was announced that Greenspan was setting up something called the President's Working Group on Financial Markets, which later colloquially became called, the Plunge Protection Team. And of course, the Treasury Secretary, Greenspan, several of the big bankers, et cetera, they were all put on this board. And it was a precursor to the Exchange Stabilization Fund, which the Fed ran. But basically, what it said was they weren't going to let this shit happen anymore. They viewed, massive moves in markets could damage the position of the government, and therefore the government was going to start becoming an active participant in the markets. And this is why, at critical junctures, the government will buy the S&P futures to prevent certain technical levels from getting taken out, or they'll sell short the gold prices because, their technical levels, they don't want to see it go through. And we've lived under this regime since that time, since 1987. I mean, and by the way, the Exchange Stabilization Fund, which started off as 20, 30, 40 billion, almost a joke, it's now up to $600 billion. It's run by the New York Fed, and they operate in every single market out there. And there are a number of executive orders that we've read over the years. There's a great site that documents all this called GATA, GATA.org, which is Gold Antitrust Action Committee.org. The guys who run are fabulous guys. But, there've been all kinds of executive orders that basically say that the president has the right, the president and Treasury Secretary have the right to intervene in markets if they think it's in the nation's best interest.
Yeah.
And guess what? They do 24/7, right?
Yes. So then, right. So flash forward from the 87, they placed the put in place, right? That was where it would kind of solidify. Don't worry, we have your back there. They put the safety net under the market, right? And then flash forward to 1998, and you've got the two geniuses who started, who came up with the Black-Scholes model, right?
Yeah.
And that was the option pricing model. And they started long-term capital management. These guys were shorting volatility basically in a time when the Russian ruble came unhinged, and we had a market collapse of the interest rate volatility spiked, and it blew these guys up. Well, what happened? They were so indebted. They were so levered. They were levered somewhere around 100 to 1, right, Larry? They had about $1 billion of AUM, and they had $100 billion of investments that we know of, and they had counterparty risk everywhere. So Goldman Sachs went into the New York Fed and banged the table and said, we're going to all collapse. So we're going to take everybody down with us unless you save us. And so even though the Fed didn't give them money, they brokered a deal for the other investment banks to save them. And that's where it really solidified. And that was Greenspan.
I remember it was August 1998. I remember like it was yesterday. Again, my PA went up 100% in a month on all my shorts. And as you pointed out, Goldman Sachs went in there. Bear Stearns didn't play, as you remember, which is why they were assassinated later.
Right.
They came back, and it was very clear the fix was in. And thank God I covered my shorts because the market went on an enormous tear. And I thought 98 might have been the top of the dot-com bubble. And as we know, we were only getting warmed up.
Yeah.
99 and 2000 were two of the nuttiest years in the financial markets I've ever seen.
Yeah, that was the original. That was the original use of the put, really, where they
and it just continues. It continues and continues. I mean, obviously, 2008 was a famous example of it, and 2019 was an example. March of 2020 was a famous example. I mean, basically, the U.S. government bond market went no bid, and Powell had to pretend he was Draghi and say whatever it'll take, and it's interesting, behind the scenes, we find out in each of these events that literally trillions of dollars that are put out there. I mean, we put $3 trillion on the Fed balance sheet in 2008, but at one point, Bernie Sanders did an FOIA request, and he found out that at one point in time, the Fed had $20 trillion of swap lines out in the 2008 crisis. I mean, they just flooded the system with money.
Yeah.
And with each of these, it gets bigger, right? So in 2008, we went from $1 trillion to $3 trillion over the course of 3 or 4 years with QE 1, 2, 3, et cetera. In 2020, we went from 3 and change to 9 in the space of 9 months. I mean, it's nuts. I mean, and the next one will be 20 trillion. And this is my point. This is the point about exponential growth. And I think the average human mind just doesn't fully grok exponential growth and the way things can compound, and the way that once lines start to go very vertical, the second derivative becomes extremely high, and the system is unstable and it's going to explode. And I've got some examples of that. I don't know if Sam, if you want me to give the stadium example or not, but
dude, I love that example. Go for it.
Okay. This is, I'm borrowing this. None of my ideas are original, by the way. I borrow damn near everything I've got. I'm borrowing this from Egon von Greyerz.
Like the U.S. government.
Yeah, who's a gold guy in Switzerland. I just find this amazing. So imagine a football stadium, right? And every minute, 1 drop of water is added to the stadium, and every minute, the number of drops you add doubles. I did the math on this, and I think it comes out accurately. I could be a little wrong, but it makes the general point, even if it's slightly off. The general point is correct. So it goes from 1 to 2 to 4 to 8 to 16 drops. And you say, how long would it take to fill this stadium? And you think, a day, a month, a year? No, it would take 50 minutes to fill the stadium, which is amazingly short. But the more interesting thing is think at how it ends. It's hard to understand how full the stadium would be after 45 minutes. You ask people, well, how full is it after 45 minutes? And people might think, well, it's pretty damn full because you're getting near the end. No, at 45 minutes, the stadium is only 7% full. Okay. So in the last 5 minutes, the stadium goes from being 7% full to being 100% full. That's what we mean when we say, I went bankrupt slowly and then suddenly all at once.
Yeah.
I mean, the compounding of the math in these situations, people don't understand it. And so when this happens, and we can get into what I think is the timing on it all. When this happens, people are going to be absolutely shocked. And there's a great Weimar chart that shows the volatility and how it happens. And we're still in the early days. I mean, my outside goal for outside target for when this happens is going to happen before 2032, no doubt in my mind. Probably it's going to happen late 2028 or 29. That's kind of my estimate. But when they have to reverse the one we're in right now, the Fed balance sheet's going to double again, and inflation's going to roar again, and the price levels are going to go up again, and gasoline's going to be $10 plus again. And, I don't know what they'll do to try and get all that under control, but they'll do something. And then maybe there'll be a downward impulse, but you can kind of see where we're going here.
Well, issue and monetize debt. And then to your point there, Larry, one of Jeff Booth's favorite examples is how many folds of a piece of paper does it take to get to the moon from here?
Right.
And it's 42 folds. Okay. So that's fine. But if you think about it, you're at fold 40, you're only a quarter of the way there.
Right.
41, you're halfway. 42, you're there.
Right.
Boom. Done.
Right. Same idea. The human mind doesn't really understand exponential functions very well.
Yeah. Let's look at one chart to kind of show this. This is the debt held by the Fed. That's gone pretty exponential over the last couple of years. I think that's what you're talking about, Larry.
That's exactly right.
We know what's going to eventually happen when things hit the fan. They're going to resort back to what they've always been doing, which is what James just said. They're going to start monetizing the debt.
Yeah, look in 2011 where they look at that spike, and then compare it right? So you compare it to the next spike, right? I mean, come on.
Yeah. And so you look at this chart and, Fitch just downgraded the US debt. But then you have Treasury Secretary Janet Yellen, which is another culprit in this whole debacle. But she goes out and says they're completely flawed. It's an entirely unwarranted downgrade. And then you have former Treasury Secretary Larry Summers come out and says that the idea of, the risk of a default on U.S. Treasuries is absurd. And I don't think that Fitch has any new insights. And he basically disagreed with the whole thing. It's pretty rich coming from those two people. But the fact of the matter is they keep spending. They keep spending.
That's right. Well, and the thing is that it's not inconsequential. It's not. If you're an investor, you don't get paid, on something that you're expecting. It's supposedly a zero risk asset. Like this is supposedly the risk-free rate is, it's the U.S. Treasury. It's the risk-free rate. And we're not, you can't assume that. You cannot assume that you will get paid on time every single bond that you own. You just can't. I wouldn't own long duration treasuries. I own some short ones, but that's just because I can expect that we're not going to hit the debt ceiling tomorrow or this next month, but I don't know what's going to happen in 5 years, 7 years, 20 years, 30 years, and then they talk about 50-year bonds. No way, man. No way. 0% probability that I'll be buying one of those. So
yeah, the credibility of all these people, Sam, to your last comment, I mean, it's just in the toilet. And I mean, why anyone listens or pays attention to anything these people have to say, it's just, it's beyond absurd to me. But, we still have a system that, used to trust the Wall Street Journal and the New York Times and the government and so on and so forth. And, the rest of us are sitting here forced with that old decision of who are you going to trust, me or your lying eyes, and I'm trusting my lying eyes. So
yeah, it reminds me of didn't Argentina issue like 100-year bond?
Yeah, they sure did. Yeah, how'd that work out? I mean, and by the way, I mean, I think Argentina has defaulted 3 or 4 times. I mean, Turkey is in the process of defaulting right now, as we all can see. And I'd be curious James's view on this. I'm sure he agrees with me. I think Japan is in a lot of trouble. I mean, they might be the first to go, right?
Yeah, they're in serious trouble. They already own. So for your listeners who haven't been paying attention to the situation in Japan, Sam, what we have now is they've been doing something called yield curve control on their bonds, right? So you look at the 10-year Treasury, it's kind of the benchmark bond. It's the bogey, right? So they're trying to hold interest rates down because they have a completely different economy. They're a net exporter. They have a different demographic, much older retiree system. But what they've been doing is they've been holding interest rates down they're trying to inflate things. They're trying to get inflation up in order to pay down past debt. I mean, they need more inflation. Okay, so by what they do is they go in, they buy bonds. They buy the 10-year bonds to keep it. And last year they kept it at 25 basis points. And then there was just too much pressure. You saw that the yen was exploding versus the dollar, meaning that it was imploding actually. So as the yen goes up, it's actually an inverse quote on FX, and that's bad for the yen. It's number of yen per dollar. And so as that was happening, the Bank of Japan, they were selling US Treasuries to get dollars to sell to buy yen in order to hold the yen from going too far outside of bounds while they're buying their own debt. So the Bank of Japan is buying their own debt, right? And they're monetizing. It got to the point where they had to step back and say, okay, no, we're not going to hold it at 25 basis points anymore. We're going to let it go to 50 basis points. Well, why? Because the US Treasury is trading at 4% and they're trading at 25 basis points. People are selling the Japanese bonds at JGBs in order to buy treasuries because you're getting a better yield here. And there's a lot of pressure, and that pressure is that they need a release valve, right? The investors need that kind of pressure builds up, and the release valve was the yen. And so then this past month, they surprised the market again and said, okay, well, 50 basis points is where we're going to hold it. Kind of that's the target. but the absolute most we're going to let it go to is 100 basis points, 1%. Okay. And so what happened? It immediately shot up, right? And so it blew up through 60 basis points, 65 basis points. And the Bank of Japan had to do an emergency buying, a bank buy, a treasury buy. So they were in there buying their JGBs again. And it's to the point now where Japan owns more than 50% of all outstanding Japanese government bonds. They own the bank of the central bank that is basically issuing these bonds owns more of them than anybody else. I mean, that's just nuts to me. But it's going to continue like this, just like Larry said, until it doesn't, and it breaks, and the loss of confidence goes high enough that it's gone. That's it. It's over. So I don't know when that happens, but I am worried for them.
Yeah.
And they are in a different demographics. They have different levers to pull than we do here in the United States. However, we have we're fortunate enough to be part of a system that's got the global reserve asset and the global reserve currency. And so, but they're not. So what happens from here? I don't know. I agree with you, Larry. It's a race between them and the euro breaking up. I don't know which one goes first.
Yeah,
they're both
Definitely.
a problem.
Max Kaiser was similar on the last episode. He was like, just watch Japan. Obviously, their debt to GDP is the highest in the world.
That's over 250%, right?
250%. So they couldn't let their yields rise, so they kind of capped it down just because they wanted to spur inflation to help inflate it away, but also to keep the interest expense down on that massive mountain of debt. But now it's creeping up. But also, Japan's inflation is at a 42-year high. It's actually creeping up there.
Well, they've got a problem. I mean, they were net exporters, and they still are, but not by as much. And their energy costs eat them alive. I mean, Japan doesn't have any natural energy on their own. I mean, it's an advantage we have over them. We have shit.
No, did they restart that reactor? Because they're I mean, that's the other issue.
I don't know.
Yeah, they have to import natural gas. So
but how does that affect like the U.S. Treasury market, James? Like, if you could break down maybe the connection of why Japan raising that limit up to 1% now, like what are the dynamics there where that actually impact the U.S. Treasury market? Because I think obviously our listeners would be interested to know that.
Yeah, it's called interest rate parity, right? And so when you have two interest rates and you're looking at the similar bonds, a 10-year U.S. Treasury and the 10-year JGB, right? Where are they trading? Where are the yields? Well, if the U.S. Treasury is yielding 4% and the JGB is yielding 0.5%, well, what people do is they will sell JGBs, get yen, sell yen, buy U.S. dollars, and buy the Treasury. And then they come into some sort of parity on the futures. And what happens is that the currency futures, to hedge that trade out, they go to a spot where they go to parity, right? And so, but there's pressure on the JGBs to be sold in order to meet the pressure of the yield, because they're searching for yield. They need yield, and so they will go elsewhere for that yield. And so they kind of balance each other. So if you look at the move of the spread between the U.S. Treasury and the JGB 10 years, okay, if you look at that spread, you can chart it against the spread between the US dollar and the yen, and they track almost perfectly. And that's called interest rate arbitrage and interest rate parity.
But what James is alluding to is also said another way is the yen has been the currency that's been used for the carry trade, right? It's been the cheapest currency to borrow in the world for 20 years. And so a lot of, and by the way, when we look at liquidity, it's not just the Fed. You've got to look at, world liquidity. And Preston Fish had a great chart that showed, the Fed is tightening, but the rest of the world's printing like crazy, especially China, by the way. And so, global M2 is growing in spite of the Fed being tight. But the point is, if people are borrowing in cheap yen and using that as part of the carry trade, if suddenly that cost to borrow goes from zero, which is what it used to be, then it went to 50 bips on the first move, and now it's at 65, maybe on its way to 1. At the margin, admittedly, these are all still small numbers, but at the margin, that makes that borrowing more expensive. And so people are going to do less of it. And so it's going to restrict liquidity.
Yeah, there's a lot of hedge funds do that. And so what they're doing is they're shorting that 10-year Treasury. and then getting yen for that, and then using that yen. They're borrowing the yen at that rate. So go ahead, Larry.
Right.
Sorry.
Yeah, no, so the point is, Sam, that what's going on over there is kind of a warning sign that, maybe they can't continue playing this game. And the reason they've been able to play this game, people ask me often to say, how come Japan hasn't hyperinflated? How have they been able to get away with this? And it's just because they have such a net asset surplus, in terms of external things they could sell. Whereas, of course, the U.S. has a huge deficit, and Luke Groman does a great job of pointing that out. But they also are net exporters. They have enormous cash flow coming in because they sell more than they buy, even though they buy all their energy. And then as a people, they're a bunch of savers. They're not like us. They're not heavily in debt. And so they buy their own debt. So all of those things are good for them and have allowed them to play this roll up until this point in time. But all of those things, I think, are starting to head in the other direction. And that has an implication for liquidity throughout the world.
And we're in it. Who knows how long it takes, but we are absolutely in this.
There's no doubt.
Larry said, we're in the end game. The end game could take a long time. You don't know how many sets it's going to take to finish the Wimbledon final, or how many overtimes it's going to take, but we're in it. And it's just a question of when that last, straw breaks.
We're definitely in it. I mean, the CRE, my partner did some great work, and he showed how, half the U.S. banks, half the small regional U.S. banks are effectively bankrupt as a result of the CRE problem. I've got comparables that show, malls that, like a mall in the middle of Connecticut, 10 years ago was valued at, $100 million. It recently sold for $6.5 million. This is
online retail.
That's partly the Amazon effect, right? Being a mall in a small area doesn't work anymore. But the point is that there is what James and I are alluding to here is that, a bunch of years of fake money and free money has completely and utterly distorted this financial system. It is so bent out of whack compared to what it normally used to be when I first started in this business, as to be unrecognizable. And those who say, oh, well, we corrected it in 2022, let's buy the dip. The 5 by 5 year swap's going back to 2.75. It's all going to be good. They're out of their fucking minds.
Yeah, they're trying to front run.
That's just not how this ends. This does not end well. So,
well, and the point is, the CRE situation, everybody's got their eyes on that, and they're watching for these. For the owners just walk away from these non-recourse loans and hand the keys back to the banks. The banks are saddled with these half-empty offices that are now worth a fraction of what they were when they loaned money against them. Now they've got this impaired asset on their books. You can go into the listings now, and you see some of these commercial listings that they're not even pretending that they're going to try to sell them for office space or lease them for office space anymore. They're saying they can be converted to apartments now. They're showing them as apartments, and it's like you can see that those are, it was a little the cubicle farms. You can see it's a cubicle farm, and they're trying to rent it out as an apartment. And there's no grocery store around. There's no gas station around, and you're like, how are people going to live here? So that is a problem. But I don't think that's really the canary in the coal mine, because here's the scary thing, is that people's attention is on that, and they're still worried about it. What are we not seeing? Like, who's out there who's impaired that we're not seeing? We just saw Yellow collapse, one of the largest truckers in the nation, right? The long distance trucking line, right? Well, was that impactful? Yeah, 30,000 people are going to lose their jobs. It's impactful to the economy. However, what's interesting about it is that that's the kind of thing that just gets swallowed by the competition. So that's not that, as far as an impact to the economy, probably not that big of a deal. What's out there that's going to be a big deal? Who's over levered that it's going to have a contagion effect? And not just banks. It could be an insurance company. It could be a massive investment bank. It could be a massive investor. It could be, we don't know what it is, but what's out there, because the system is so levered that when something breaks, it's going to impact other
in my
things.
view, it's not necessarily what's out there in the private sector, because this is a sovereign credit bubble. It's a sovereign debt crisis. What's amazing to me is if you look at the charts of the U.S. fiscal deficit, here we are at near full employment with a theoretically healthy economy, and we're running, enormous deficits. I mean, and if you look at what happened in 2000 and you look at what happened in 2008, and you can see it recently. The Journal had an article on it last day or so where they talked about how basically tax revenues are down 10, 11, 12%, and expenses are up 10 or 11, 12%. And that's in an okay economy, and it's going in the wrong direction. So, take more yellows and take more layoffs and take a real slowdown in the economy, and then all your transfer payments go up, your food stamps go up, your welfare goes up, everything else. And, continue on the spending ways that we've been continuing on. And, the U.S. is going to be running a $2+ trillion deficit headed to 3 or 4 for a long damn time. I mean, here it is. I think these are the numbers that they gave us. Is that correct, James?
Yeah, these are from the CBO that they were repurposed. But yeah, this is I think I got this from the Peterson Foundation, but exactly. And this is kind of optimistic. That's
right. I think it's going to be worse than this.
Yeah, that's the scary part. This is optimistic. They did not expect to be paying $970 billion on interest expense this year.
Right.
Not even right. And now you've got over 40% of the debt due, and that is maturing in the next 2 years. So that's going to be issued at what? If it's right now yielding 1.5% on average, it's going to be yielding over 4% on average.
Yeah. So here's a scenario of how it unfolds. The 10-year goes to 5%. The 1 year and the 2 year go to 6 or 7%. The federal deficit, blows out to north of 2 trillion, on its way to 3 or 4. Interest expense on the federal debt, starts to approach 1.5 or higher. It's a death spiral. The more they run a deficit, the more they've got to borrow. The more the bond market continues to fail because there aren't enough buyers for those bonds. And this is the death spiral that James coined this term, right? The more the bond market starts to fail, the more interest rates go higher. The higher the interest rates go, as we all know, the government made the enormous mistake of not terming out a lot of their debt. I mean, there's an enormous maturity wall. In the next 2 or 3 years, they've got $8 trillion of debt rolling over, maybe more. And so that's all got to be done at the short rate, which is now 5.3.
Yeah.
Imagine that's 6 or 7, right? I mean, and you can see, this is the airplane that's auguring in, and pulling back on the elevator is what's making the spin, is making the auguring in tighter, because interest rates go higher, costs go higher, more bond gets sold, blah, blah, blah. It's a death spiral. I mean, to me, and at some point in time, enough participants start to realize, holy shit, there's no way they're going to get out of this thing unless they print to a level that's just beyond absurd. And therefore I've got to get into some money that's not tied to the government. And that's, the two choices are gold and Bitcoin. And that's why, to me, the clue that this is going on, real interest rates have gone up over 500 basis points in the last year and change, right? That should have destroyed gold. Gold would have gone from 1950 to 1600, but it didn't. It's right at 1950. It's within 6% of its all-time high. That should have destroyed Bitcoin. And yet Bitcoin went from 15,000 to 30,000. It's the best performing asset this year. It's up, I guess it's 28, 29 now, but it's up 75% year to date. Why? Because those two asset classes can smell what's coming. They know that the big print is ultimately coming. Doesn't matter what the hell the Fed says. Doesn't even matter what the economic statistics are. I loved Nat's recent interview with Saylor, where he basically said, I don't even look at that macroeconomic stuff because all those numbers are made up. They're total bullshit.
Yeah. The CPI is made up. It's all bullshit. Yeah.
Yeah. We got 40% unemployment. They're telling me it's going up from 3.0 to 3.2. It's like, give me a fucking break. I had to laugh out loud. The point's a good one. James and I are sitting here watching every little wiggle in these numbers, and the numbers are all just made up.
They're all made up.
Look, sound money assets are going to absolutely soar as this problem unfolds. And the only question is what time and what rate.
Yeah, and it doesn't and it doesn't really necessitate a massive print yet for that to occur, right? Because like we've talked about, and Sam, you and I talked about this last week, is there's three options that they have basically on the table. The Congress can issue austerity, which is cut spending. What are they going to cut? Are they going to cut entitlements? Are they going to cut defense? I mean, they are already up against the wall. They can't cut the interest rate expense. So the interest expense. So and that's political suicide. So they're not going to cut anything, right? Neither side wants to. They're trying to trick the other side into doing that to lose votes. They're not going to do it. That's number one. Number two, they could raise taxes. But Larry, that raising taxes it winds up stifling productivity. In the long run, you get to the same spot and it doesn't help GDP and it doesn't help tax revenue. It doesn't help your deficits. Right. So that's number two. Number three, what they could issue debt against it and just grow the debt. Of course, that's what they're going to do. Or really what the answer is, number three, is allow for long-term high structural inflation. Hide it from everybody, lie about it. Don't let people know how much the inflation really is, but that inflation creates GDP nominal growth, right? That allows for tax base to grow and pay down former debt with cheaper dollars, cheaper future dollars. That's their only choice now, and that's
squared. I mean, they're
going, right?
Yeah, they've got to get R squared up to a big number, and they know it. And look, and that's why you made one statement. You said, well, they can't reduce the interest cost. Well, actually, they can, because what's going to happen is Powell's going to be forced to take rates back to zero.
Yeah.
And again, print money. So they are going to be forced. He's going to be Burns. I mean, he wants to be. Volcker, he wants to be Volcker, but if he continues that, he's going to be, Benjamin Strong and put us into a Great Depression. So he's not going to be. He's going to be Burns. He's going to have to pivot. He's going to have to print money, and the reason he's going to do it is because the alternative is the system blowing up. Yeah. And so at least that'll bring the interest cost down, for the federal government, because there'll be free money. In turn, of course, what will happen is M2 will continue to grow, and ultimately they'll have to resort to QE because interest rates will continue to go up. And so their balance sheet will have to expand.
But
so
we're still in a deficit regardless of the interest. And
that's right.
We've got $180 trillion of unfunded liabilities.
Yeah.
That's on top of all of it. So right. I mean, I'm laughing. It's not funny.
It's not funny. No, it's actually quite sad. But I'm reading Neil Howe's most recent book on the fourth turning. He's claiming it's here, and he claims his timing is it's 28 to 32, which I totally agree with. What I find hysterical about it, though, there you go. What I find hysterical about it is he can't figure out what the subject is. He's like, there's going to be a big crisis, and I don't know what it's revolving around. In the past, they've always revolved around wars, and I'm kind of like, dude, it's staring you right in the goddamn face. I mean, this is not a tough call.
Yeah,
the money's going to fail. Right?
He's noticed a couple of our debt threads recently, and he's jumped on there. So
has he? Oh, that's interesting. So maybe he's getting wise to it. I mean, he works at Hedgeye. You would think they might bring him up to speed on it.
Yeah,
well, Keith is not the brightest.
I think they are. Pack, but Keith definitely is in our camp here.
Yeah. Although we should just
not in the Bitcoin camp, but he's in the
they'll all get there.
Yeah.
But they're running these deficits and huge deficits, and we're not even in a recession yet, but we are starting to see kind of signs and cracks. We have for a while now. I think these things just take time, but what do you guys see in the next 6 months? Because you say they'll have to cut rates, they'll have to print. And I agree, but at the same time, they're not going to do that unless things are really bad
things have to get very bad very quickly. I think what they're missing is the lag effect. I mean, we went to an event with BJ Dichter, who was the guy who did the truckers protest up in Toronto, and he gave us a great data point. And he trucks a lot of products that get brought to the United States to turn into corrugated paper boxes. And it's a great leading indicator for sales in the United States. My partner David Foley figured this out and talked him through it. He said that in the last couple of months, demand has literally fallen off a cliff, like down 90%.
Wow.
And that this generally presages a serious downturn. Also, if you look at the 210 spread, same story. I mean, my opinion is sometime in the next 6 months, this economy is going to hit the wall so friggin' hard, people are going to be stunned. Yeah. They're going to be absolutely stunned at how quickly everything turned. And then the stock market's going to go down. And by the way, that's going to take tax receipts down. And then people are going to start worrying about the jobs, and they're going to cut back on their spending. And then all this credit card debt they've taken out is going to become a bigger problem.
They're all red flags.
Suddenly inflation is going to seem like a thing of the past. And the whole issue is going to be, how do we prevent the economy from collapsing? And that'll become the narrative. So Sam, whether, I happen to think that'll happen within 6 months. My partner's more conservative. He thinks it'll be within a year and a half, and that may be true. But I always kind of think it's right around the corner, and I've been wrong and early many times. But the point is, it's coming. It's definitely coming. The economy is going to hit the friggin' wall.
Yeah.
So pull up that chart again of that 2-year, 10-year spread, right? So this, for everybody, this is the 10-year yield minus the 2-year yield, and what it shows that the 10-year yield is a lot lower than the 2-year yield, which means that investors expect for rates to come down, which means they expect a contraction. If you look at those gray bars, that's where those recessions are, and you can see where it turns negative, where this spread turns negative. It takes about 6 months to 18 months for it to play out, and then you get your recession, and that happens every time. Have you ever seen that chart that I've put up about the unemployment? Have you ever seen that one, Sam? Where the unemployment, we keep hearing the Fed talk about, well, the employment's strong. It's not, there's no signs of recession. What happens is employment ticks up just barely. And then once you hit the recession, it spikes. It goes straight up through it goes absolutely parabolic through the roof. That's when you get your unemployment, after recession starts. And it happens every single time. So everybody, listening to Powell and hearing him talk about how employment's still strong, it doesn't matter. It's going to tick up just a little bit, and then it happens all at once, where you have massive layoffs all at once. Now, I don't know if this happens because we have a credit event, or if it's just a watershed moment where the economy just finally rolls over. But I'm with Larry on, by and large, that we're going to have this happen somewhere in the next 6 to 12 months. And it's just reality. You have this lag effect of raising these rates so rapidly from 25 basis points up over to 5.5% on the Fed funds rate. Like, you can't do that in a year and not expect there to be some sort of lag effect on that. And that's where we're starting to see things like a company like Yellow just dissolve because they got over levered. That interest rate risk they were exposed to, they got hammered on. Or like the Silicon Valley Bank, where they were exposed to interest rate risk, they didn't hedge it, and they got blown up. Things like that are happening. They're going to continue to happen. I don't know what credit event we see, but I believe that there is a significant chance that we have some sort of credit event because of that lag effect of that interest rate rise. We just
like Saylor, I'm unbelievably bullish for really 3 reasons. One, we're going to have something happen that's going to force them to change policy and go in the other direction. 2, we've got a halving coming up, and 3, we've got the Bitcoin ETFs coming sometime within 6 to 9 months, which are going to unleash enormous amount of demand into a very tiny market. And so I just don't see how we're not at Bitcoin between 100 and 400,000 sometime within the next 2 years. I mean, I just don't see it. To me, it's statistically impossible.
Yeah, I was gonna.
It doesn't happen.
Yeah, you're referring to that great Saylor interview on Coin Stories, I think last week, and he said he was so bullish, and that's what I was going to ask you guys, because if you look at these macro indicators and these the deterioration
we sound terribly bearish, right?
Yeah, but I'm wondering, there might be a correlation to one event, but there are these developments happening in Bitcoin that are bullish. Like, there's a lot of building going on.
Oh yeah,
a lot of institutional adoption, and then could this be the time, do you guys think, where you could see things start to break down, but Bitcoin kind of sees through it all? Because I've always kind of viewed it as a hedge on the existing system, and Bitcoin's just a function of the environment it's in. And if everybody's starting to get worried about the debt situation, things that Bitcoiners and gold advocates have talked about for many years, do you think that Bitcoin can kind of break away from other?
I think Bitcoin and gold are going to separate. I mean, I think if we had a if in March of 20, when that happened, Bitcoin went down, gold went down, everything went down because we had a correlation.
You have a puke, everything correlates to 1 when that happens.
Very briefly, until they came in with the Draghi, whatever it takes statement. And then, of course, gold went up $100 2 days in a row. I'm not even sure we get the down on this one. I mean, I think I think Bitcoin and gold already smell what's coming. And so as a result, whether this comes immediately or in 12 months, doesn't really matter. I think they're both bullish, as a result of that.
Mhm.
When it comes and when the Fed reverses, when they clearly are done, quote unquote, these things are going to take off like scalded dogs. I mean, it's going to be something.
Like, what did you say? Scalded dogs?
Scalded dogs. You haven't heard that phrase?
Dude.
You're not a Southerner.
I've heard. I just can't believe you pulled it out of your hat.
Yeah.
It's awesome. We need to end on that. Larry, you and I have a general partners meeting.
Yeah, you guys got to
go. Jump off.
1 minute.
Thank you, Sam, for having us on your show. It's always a pleasure. You guys are doing such great work, and you and Nat, it's all good stuff.
Awesome.
Yeah. You guys enjoy your meeting. Thanks for coming on the show. Always a pleasure. Have to have you back on again. I like to leave on a bullish note. So you guys just go enjoy your meeting and keep building over at the Bitcoin Opportunity Fund. Appreciate you guys coming on.
Thanks, Sam. Take care, man.
Thank you, Sam. See you guys.
And thanks for listening, everybody who tuned in. This is Swan Signal Live. We're going to start doing this every week, live shows. We're going to have all these kind of guests on, trending topics, big names. So keep tuning in to Swan Signal Live, and make sure to check out Pacific Bitcoin. Again, promo code SIGNAL to get 21% off your ticket, October 5th and 6th in Santa Monica. Thanks for listening, everyone.